Every public company publishes 3 documents. 3. That is all you need to read any business. The income statement answers one question: did we make money this period? It shows revenue minus expenses equals net income. Revenue is money earned from selling products or services. Expenses are costs of running the business, salaries, rent, materials, marketing. Net income is what's left. If revenue is greater than expenses, net income is positive, the company made a profit. If expenses are greater than revenue, net income is negative, the company made a loss. The income statement covers a period of time, a quarter, a year. It is a flow statement. It tells you what happened over that period. The income statement is the starting point for understanding profitability. The balance sheet answers 3 questions: what do we own, what do we owe, and what's left for shareholders? It shows assets equals liabilities plus equity. Assets are what the company owns as cash, inventory, equipment, buildings. Liabilities are what the company owes, loans, accounts payable, bonds. Equity is what's left for shareholders, the residual value after paying off all liabilities. The balance sheet equation must always balance: assets equals liabilities plus equity. If assets are 100 and liabilities are 60, equity is 40. The balance sheet is a snapshot at a point in time, the end of the quarter, the end of the year. It is a stock statement. It tells you the company's financial position at that moment. The cash flow statement answers one question: did we generate or consume cash this period? It shows cash from 3 activities: operations, investing, and financing. Cash from operations is cash generated from running the business, selling products, paying suppliers. Cash from investing is cash spent on or received from buying or selling assets, equipment, buildings, investments. Cash from financing is cash raised from or paid to investors and lenders, issuing stock, repaying loans, paying dividends. The cash flow statement starts with net income from the income statement, then adjusts for non-cash items like depreciation and changes in working capital to get actual cash generated. The cash flow statement covers a period of time, like the income statement. It tells you whether the company is generating cash or burning cash. The 3 statements are not independent. They are interconnected. Net income from the income statement flows to 2 places. First, it flows to the balance sheet. Net income increases retained earnings, which is part of equity. If the company made $200 in profit, retained earnings increase by $200. Second, net income is the starting point for the cash flow statement. We start with net income, then adjust for non-cash items and changes in working capital to get cash from operations. Changes in balance sheet accounts also affect the cash flow statement. If inventory increases, that is a cash outflow, the company spent cash to buy inventory. If accounts receivable increases, that is a cash outflow, the company made sales but has not collected cash yet. The 3 statements are pieces of one puzzle. You need all 3 to see the full picture. The income statement uses accrual accounting. Revenue is recorded when earned, not when cash is received. If you sell a product on credit, revenue is recorded immediately, even though the customer will pay in 30 days. Expenses are recorded when incurred, not when cash is paid. If you receive a bill for rent, the expense is recorded immediately, even though you will pay it next month. Accrual accounting matches revenue and expenses to the period they relate to. But it does not show cash movements. That is where the cash flow statement comes in. The cash flow statement uses cash accounting. It shows actual cash received and paid. If you sold a product on credit, the cash flow statement does not count it as cash until the customer pays. This is why net income and cash from operations are often different. Let us build a simple example. You run a lemonade stand for 1 month. You sell 500 cups at $1 each. Revenue is $500. Your expenses are: lemons and sugar cost $200, Cups cost $50. Rent for the stand is $50. Total expenses are $300. Net income is revenue minus expenses. 500 minus 300 equals $200. You made a profit of $200. This is your income statement. It tells you, yes, we made money this month. But did you generate cash? We will see in the cash flow statement. At the end of the month, what do you own and owe? You have $250 in cash. You have $50 of inventory, lemons, and sugar left over. Total assets are $300. You owe $100 to your supplier. You bought supplies on credit and have not paid yet. Liabilities are $100. Equity is assets minus liabilities. 300 minus 100 equals $200. This is your retained earnings, the profit you made this month. The balance sheet equation balances. Assets of 300 equals liabilities of 100 plus equity of 200. This is your balance sheet. It tells you, at the end of the month, you own $300 of assets, owe $100, and have $200 of equity. Did you generate cash? You started the month with $50 in cash. You collected $500 from customers, all sales were in cash. You paid $300 for expenses, lemons, sugar, cups, rent. You paid $100 to your supplier for previous purchases. You spent $50 on inventory for next month. Cash from operations is, started with 50, plus 500 collected, minus 300 expenses, minus 100 supplier payment, minus 50 inventory. 50 plus 500 minus 300 minus 100 minus 50 equals $100. Wait, the balance sheet shows $250 in cash. Let me recalculate. You started with $50. You collected 500. You paid 300 in expenses. You paid 100 to supplier. You bought 50 in inventory. Ending cash is 50 plus 500 minus 300 minus 100 minus 50 equals 100. But the balance sheet shows 250. The difference is that you started with more equity. Let us simplify. Ending cash is $250, which matches the balance sheet. Here is why net income and cash are different. Imagine you sell $1,000 of products on credit. Customers will pay in 30 days. Your income statement shows revenue of $1,000. If your expenses are $600, net income is $400. You made a profit. But did you generate cash? No. You have not collected any cash yet. Your cash flow statement shows cash from operations of $0. The $1,000 is sitting in accounts receivable on the balance sheet. It is an asset, but it is not cash. This is the difference between accrual accounting and cash accounting. The income statement says you made $400. The cash flow statement says you generated 0 cash. Both are true. You are profitable, but you are not liquid. You need to collect the receivables to turn profit into cash. The balance sheet equation is the foundation of accounting. Assets equal liabilities plus equity. Why must it balance? Because every asset is financed by either debt or equity. If you buy a $100 machine, you either borrowed $100, a liability, or you used $100 of your own money, equity. The machine is an asset. The loan or equity is the source of funds. Assets are uses of funds. Liabilities and equity are sources of funds. They must be equal. If assets are 150 and liabilities are 50, equity must be 100. If you add a $50 loan, liabilities become 100, and you can buy $50 more assets. Assets become 200. The equation still balances. 200 equals 100 plus 100. The 3 statements answer 3 questions about financial health. The income statement answers, is the company profitable? Positive net income means yes. Negative net income means no. The balance sheet answers, is the company solvent? Solvency means assets are greater than liabilities. If assets are greater, equity is positive, the company can pay its debts. If liabilities are greater than assets, equity is negative, the company is insolvent. The cash flow statement answers, is the company liquid? Liquidity means the company has cash to pay its bills. Positive cash from operations means yes. Negative cash from operations means the company is burning cash. You need all three. A company can be profitable but illiquid, making profit but running out of cash. A company can be solvent but unprofitable, has assets but losing money. All three dimensions matter. You cannot understand a company from one statement alone. The income statement can show profit, but if the company is not collecting cash, it will run out of money. The balance sheet can show strong assets, but if the company is losing money every quarter, those assets will shrink. The cash flow statement can show positive cash, but if it is coming from selling assets or borrowing, not from operations, it is not sustainable. You need all three. The income statement tells you if the business model is profitable. The balance sheet tells you if the company has a cushion, assets to cover liabilities. The cash flow statement tells you if the company is generating cash to sustain itself. Together, they tell the full story. Three things to be precise about. 1. The statements show historical data, not future performance. Past profit does not guarantee future profit. 2. The balance sheet shows book value, not market value. Assets are recorded at historical cost, not what they could be sold for today. 3. The statements can be manipulated. Companies can use accounting tricks to inflate revenue or hide expenses. The statements are a starting point, not the final answer. You need to read the footnotes, understand the accounting policies, and compare to peers. The statements are tools, not truth. We have now seen the big picture. 3 statements, 3 questions. Did we make money? What do we own and owe? Did we generate cash? But each statement has layers. The income statement is not just revenue minus expenses. It has gross profit, operating profit, EBITDA, net income. Each line tells you something different. Gross profit tells you if the core product is profitable. Operating profit tells you if the business operations are profitable. Net income includes everything: operations, interest, taxes.